Good afternoon. This is Tony Cherniawski with the Practical Investor, LLC. Today is November the 11th, 2008, and the name of this program is Over $2 Trillion Spent, and all I got was a t-shirt. No, I'm not wearing a t-shirt. I'm sorry. I didn't have one made, but if anyone would care to send me one, I'd be glad to take it. The point is, though, that we've been watching the news and with growing alarm as more and more of our taxpayer money is being spent on this bailout, and yet there seems to be no end in sight. This week AIG came back to the trough for a second time. And we're seeing not just bailouts here in the United States, but we're seeing it worldwide, including China. So what's going on here, and what effect is it having on the markets? You would think that the market should be in a healthy recovery by now with all of this stimulus going into the markets, but it seems like really that's not exactly what's happening. So let's take a look right now at what we're seeing. Well, looking at the Dow Industrials, one of the things that we're now viewing is a resurrected pennant. You may recall at Flags at Half-Mast over the markets, I brought up the idea of a bearish pennant. This is basically Technical Analysis 101. Really, there's not much to it. The thing that came to mind, though, was that the pennant usually takes a little bit longer than I had originally anticipated. So what I had described as a pennant became somewhat of a wedge, if you recall. Now we're coming back down to the lower trend line, and it seems like it's holding. So we have yet one more spurt to the upside, and then we see the decline. So what's going on here? Every one of these rallies seems to happen when there's important news. First of all, we had the bailout of AIG. We had Lehman Brothers collapse. We had all the banks getting money and so on. That was the big news in early October. Then we had the election towards the end of October and into November the 4th. And, of course, we had a week-long rally there. And now we have the G20 meeting coming to Washington this weekend. These are the government leaders of the world who really don't want to let it be known that they have lost control of the markets. You can see from this pattern right here that they really haven't been in control from the beginning, but they're going to make one more attempt, I'm certain. So let's take a look at what we have here. A pennant is almost always preceded by a straight line or a falling market called a flagpole on heavy volume. The pennant, on the other hand, moves sideways on very light volume. That describes the pennant to a T. The prices on the pennant pause at a certain point and resumes a burst of trading activity that gives a false impression of a recovery. That's what's coming up next, the false impression of a recovery. This is coming just in time for two things now, the G20 meeting this weekend and options expiration next week. We'll discuss both in a little bit more detail. Okay, both patterns occur, these patterns occur at the midpoint of a market move. So in other words, we're only halfway there, folks. The rest of this pattern is yet to develop, and it looks like a Dow of 6,000 would not be out of the question. The flag resembles a symmetrical triangle, which we have, usually horizontal. This isn't quite horizontal, but I think it fits the pattern. In fact, I suspect that tomorrow morning we'll see yet just a little bit more of a decline in the Dow because we're short about 20 points on the Standard & Poor's of meeting the bottom trend line. And then this pattern should finish with one final fling to the upside. Let's take a look at the Standard & Poor's, and what we have here is the same thing. Notice that we haven't quite hit the lower trend line. The Standard & Poor's is an exact horizontal triangle pattern, so the Standard & Poor's fits very, very nicely into this scenario. So it appears that we've got just a little bit more of a decline to go tomorrow, possibly to 860 or 865, and then a resumption of a rally that should take us possibly through the weekend. And finally, I'd like to point out that gold has one as well. This isn't quite a perfect pennant, but it sure fits the bill. This is GLD rather than gold, but gold also has a less perfect pennant, so I'm showing you the one that really fills the bill much more adequately, in my opinion. So what we have here is a pattern in which we should see a rally very, very shortly. This rally may even have a breakout to the upside, so let's talk about that. If we go back to the Standard & Poor's, the breakout could occur at a little bit over 1,000, so we could see as much as 1,010, possibly even 1,050 on the breakout in the Standard & Poor's. This is not going to be unusual for this type of pattern, so just be aware that this is not bullish. This is indeed very bearish, and you'd want to be out of that rally by the time the pattern crosses back below the 1,000-point trend line. If we look at the standard or at the industrials, we'll see the same thing. The industrials should take us over 9,500, possibly even to 10,000. But then once we cross back below 9,500, I wouldn't be long in any event. Gold has the same pattern again. Possibly we could rally to 78 in GLD, right around 780 or maybe even 800 in gold itself, then a resumption of the decline. By the way, where are the lower ends of these patterns? Well, in GLD, we're talking the lower end being around 40. In gold itself, we're talking about the lower end being somewhere in the vicinity of roughly 490 or so in the precious metal itself. If we take a look at the Standard & Poor's, depending on where this goes, we should still see the Standard & Poor's hit somewhere around 600 or possibly below at the end of this pattern when it's all done. And finally, in looking at the Dow also, depending on how far up it goes, could very easily end up at 6,000 or below. So these patterns are not bullish by any stretch, and don't be fooled by this activity that goes on this next week or so. These patterns have false breakouts. They're notorious for that, and they're notorious also for just bringing back that bullish sentiment that, boy, happy days are here again, and unfortunately it may not last. Now let's go back to the Standard & Poor's momentarily, because a very important point to be made here is that the no pain zone, if you've been watching Options Madness, one of the zones that I have is called the no pain zone, where the puts equals the calls in the Standard & Poor's for the November expiration. That's at 975. So I wouldn't be surprised at all to see the Standard & Poor's rally at least to 975, if not higher. This might give the option sellers a chance to buy back these puts and to sort of neutralize the market. And I wouldn't put it past Wall Street to do such a thing during this type of rally. So this rally comes at a very, very important time. We've got the G20 meeting this weekend. We've got options expiration. By the way, once we hit the top of these trend lines in all of the patterns, don't stay long, please. This market is going to be very dangerous, and the move to the downside could be very quick. I just want to say thank you for your time in watching this video. This market has just really been very strange and erratic these days, but what I'm trying to do is put some sense into all the sideways motions that we had. I'm trying to also point out that this pattern is not bullish. It's not a safe place to be. If you are unaware and unskilled at trading, it's good to stay out of it, because the turnaround could be very surprising and very brutal. So without any further ado, you can reach me at TonyC@thepracticalinvestor.com. And if there's anything I can say right now, it's please be careful and do the right thing. Thank you very much.